Hello, day traders! Another trading week in the US stock market has come to an end. Bearish sentiment is now weighing on the market due to the aggressive Federal Reserve. A bearish market associated with a decline of 20% or more from a high will mark the end of the pandemic-era rally. The Fed's unprecedented stimulus measures that sent stocks to record levels are almost past history now. With the stocks plummeting, online retailers like Amazon are now raising concerns. The e-commerce boom seems to be coming to an end. The Fed's decision to hike rates was the primary event last week. Likewise, investors will focus on the tightening of global financial conditions this week. With the inflation report looming, this is going to be another volatile week. Stay tuned and share your opinion in the comment sections. Last week, investors saw the US Fed raising interest rates by 50 basis points, which resulted in an increase in the main stock indexes on Wednesday. Chairman Powell said that the central bank is not actively considering a 75 basis point increase, so we may expect another 50 basis points rate hike at the next meeting. The reduction of the balance sheet will begin on June 1st. The symbolic rally did not last long, and stocks incurred losses the following day. Focusing on the crucial aspects of the Fed's decision, investors have taken a closer look at the new financial picture. The regulator will continue raising rates and, more importantly, limit the availability of capital. This is what any investor needs to know right now. The Fed's current rhetoric means nothing good for the stock market. The monetary tightening cycle has just begun, so the situation will only get worse. If the regulator chooses to go beyond the neutral level, the consequences could be devastating. Overbought stocks will be the first to suffer a painful blow. Tighter financial conditions will trigger a decline in key ratios such as the price-to-earnings ratio. It remains to be seen how far the US central bank is ready to go. In the face of record inflation, monetary easing is highly unlikely. The release of consumer inflation is scheduled for May 11. A modest decline in figures is expected. Even if actual results come in line with the forecast, deep hawkish sentiment will still remain. As to stock indexes, they showed a steep fall last week. The S&P 500 was bearish for the fifth trading week, making its longest downtrend since June 2011. On a Monday, the index hit its early low, breaking through the mark of 4,000 points. All in all, it lost 3.20% during the day. In spite of a minor rebound on May 10th, it still boded well for the market. The overall forecast remains negative. Major global investment companies are now trying to predict how fast and deep the key US stock indexes could fall. The market is expected to touch the bottom on October 19, 2022, with the S&P 500 and the NASDAQ being at the level of 3,000 and 10,000 at that moment, respectively. From a technical point of view, the S&P 500 broke the lower limit of the 4,060 points, which indicates the continuation of the downtrend. Limited availability of capital causes a volatility outburst in the S&P 500, which is now observed. For example, in 2018, the index dropped by almost 20% after the Fed's rate hike. Further limiting of capital availability will inevitably lead to new losses for the S&P 500. On a Monday, May 9th, the Dow Jones stumbled by 1.99%, hitting its 52-week low. Meanwhile, the NASDAQ plunged by 4.29%. As of May 6, the NASDAQ lost 22%, the S&P 500 nosedived by 13%, and the Dow Jones descended by 9.5%. Monetary tightening is not the only thing causing concerns in the market right now. Fears of a global economic slowdown are now growing as well. The ongoing COVID-19 lockdown in China keeps weighing on international trade. In spite of a falling number of new virus cases in Shanghai, local authorities continue imposing new restrictions due to the so-called zero-tolerance COVID-19 policy. Lingering supply chain issues would only make things worse, so record inflation could last longer than anticipated. The NASDAQ is also on a losing streak. The index has been perhaps the worst performer among the main US stock indexes so far. Last week, the barrier stood at the mark of 13,000 points. Breaking through it was a difficult but possible task. The situation has dramatically changed in a week, with the downtrend becoming deeper. Increased uncertainty in the market in recent days indicates that volatility will remain at a high level for a while. Some investors, however, are not ready to give up. They have ignored the current developments in the market, in particular a fall in the US government bond prices, which significantly reduces the attractiveness of stocks. Perhaps investors are still in denial of the new reality. Anyway, the market is undergoing serious changes, and the long-term forecasts are being revised. The earnings season is now perceived somewhat differently. Positive earnings reports used to drive stocks up, but not this time. Markets now show a stronger reaction to negative news. For example, when Netflix reported a 0.09% drop in subscribers, its shares collapsed by almost 40%. Pandemic overvalued stocks Meta, Apple, Amazon, Netflix, and Alphabet, as well as the 5 heavily traded technology companies, Alibaba, Baidu, Nvidia, Tesla, and Twitter, are now on a losing streak. These stocks may fall despite good earnings results. Should negative news comes in, a collapse would be even stronger. Speaking of e-commerce companies, Amazon's revenue rose by 7% in the first quarter 2022 from a year earlier, when it soared by 44%. The company's shares plunged amid disappointing results. Amazon has lost more than 15% since the release of the report on April 28 and over 30% since the beginning of the year. The rally of online retailers that started in the midst of COVID-19 lockdowns has been completely leveled out. Companies have faced some challenges, including persistent inflation, a sharp increase in staff costs, and disruptions in the global supply chains. And that's all for today. Don't forget to subscribe to the channel and leave your comment below. See you in our next video.